There's an important deadline coming up that could impact your state pension, and it's happening on the 5th of April 2025. For people between the ages of 40 and 73-ish, this could be a game changer. By filling in missing years, you could potentially increase your state pension income throughout your retirement by tens of thousands of pounds. So a relatively small investment now could mean a significantly higher guaranteed inflation-linked income for the rest of your life, making this an opportunity you shouldn't ignore. Why did I say 73-ish? Well, for men born before the 5th of April 1951 and for women born before the 5th of April 1953, you guys, I'm afraid, are on the old state pension, so this does not apply to you. So what is the state pension? The state pension is a guaranteed inflation-linked income paid to you by the state once you've hit the normal retirement date. Currently, normal state retirement date for men and women is age 66. This is going up to age 67 for those retiring between 2026 and 2028. And then beyond 2028, the age will be 68 for both men and women. The amount of state pension is currently £11,502. This does go up each year with inflation. That means for a married couple, currently you could receive £23,004 per annum inflation-linked guaranteed income from the time you reach state pension age. For most people, or for 60% or so of the population, this more than covers the essential expenditures that they have throughout their retirement. To get a state pension, you need to have at least 10 complete years on your national insurance record. To get the full state pension, you need to have at least 35 years or so complete years of national insurance contributions. This can vary. The number of contributions that you require to get the full state pension can vary depending on your personal circumstances. So do check online by getting a state pension forecast. So what does the 5th of April 2025 deadline represent when it comes to your state pension? The new state pension was introduced in April 2016. And in order to allow more people to get the full new state pension when it was introduced, the government introduced some transitional protection, allowing people to go back and plug any gaps in their national insurance record as far as 2006. For various reasons, this has now been extended, allowing people to plug any gaps from April 2006 all the way up now to April 2019. From April 2025, you will no longer be able to go back further than 6 tax years prior to that date. Hence the reason this is now the last chance to plug those gaps between April 2006 to April 2019. The question is it worth plugging the gaps in your national insurance record? Well, the answer to that question is, for some, yes, it's a no-brainer. For others, not so much. The first thing you should do is find out what gaps, if any, you have in your national insurance record. You can do this by going online and getting a state pension forecast. My other video, the link is in the notes, will show you how you can do this. You might find you have gaps in your national insurance record if you were contracted out. In the old days, you were able to contract out of elements of your state pension and instead pay those national insurance contributions into a private pension. You could have gaps in your record because you were on a sabbatical, or perhaps you were on a low income job or had a low income at the time. You get national insurance credits by working, looking after children, or claiming certain benefits. If you feel there are credits that should have been credited to you, for instance for looking after children, then you can go to the government's National Insurance Contributions page to find out how to claim any credits that you feel you are due. If you're approaching state pension age and you're still working, but your forecast shows that even if you can continue to contribute to your national insurance record for complete tax years between now and your state pension age, but you still have a shortfall, you may wish to go back, check your record, and then plug any gaps. If you're planning to stop working or you're planning to start working abroad, you may wish to consider plugging some of the gaps that you have in your national insurance record now. So long as there's no chance that you're going to come back or you're going to go back to work, and fill those gaps in naturally between now and state pension age. The key is to consider making up the gaps in your national insurance record for older payments, because they're generally going to be cheaper than making up gaps in your record for later payments. If you use my record as an example, there are two gaps, 2021 and 2022. For me, between now and state pension age, I know I'm going to naturally make up my payments just by working and earning an income. So if you're going to be between now and state pension age earning an income or getting qualifying state benefits or looking after children, which will make up the gaps in your payment, then there is little reason for you to make up any older gaps in your payment, in your national insurance record. That said, if you're uncertain, maybe you might be just choosing to retire early or something like that, then you might want to make up the gaps in your payment. So it's all about whether you're going to be making up these gaps in your record naturally between now and state pension age, or whether you're not. The size of the opportunity is potentially huge. No traditional investment will give you a guaranteed inflation-linked income for the rest of your life for the same price. Let's look at an example. If I were to make up a gap in my national insurance record that cost me £820 odd, this could buy me an additional £328 of extra income for life in my state pension. So if I had 5 years missing and purchased them at around £4,100, that would provide extra income of £1,640 per year. This over an average lifespan of 21 years for, say, a 67-year-old lady would mean that it's only 2.5 years before I actually started hitting profit. This isn't bad when life expectancy for most of us is 20 years or so. This means in retirement, the return on my investment would essentially be £32,800, which equates to 700% increase over that 20-year period. And this doesn't even include the fact that the income is inflation linked as well. To finish, topping up will not be right for everybody. So if you're unsure, speak to the Future Pension Centre or speak to the pension service. The phone numbers for which will be in the notes. You can arrange a callback. Also, if you're on pension credit or have a low income, you may wish to speak to the Citizens Advice Bureau as well to see if topping up your state pension would affect any of these benefits in any way. Also, this video should not be seen as advice, and you should not make a decision to top up your national insurance record based on this video alone. Do your own research. The idea of this video was just to raise awareness that come the 5th of April, people could potentially be missing out on quite a large opportunity. So please share this video with family and friends. I hope this video has been useful. Watch my other video to see how you can top up, and I'll see you next time.